Well, hello, Greyson Geiler here with SES Services. I'd like to find some information on the financial news wires, and weekly we give you an update going into a little bit more depth. This week, what we'd like to talk about some of the economic numbers coming in, looking recessionish. Okay, so everyone who's been paying attention to the financial situation for the last couple of years knows, well, and especially if you've been watching our market updates, you know the Federal Reserve kept financial conditions way too loose. I mean, we're talking about into the spring of 2022, less than a year ago. Fed still had basically the short-term interest rates at zero, and they were still buying $80 billion in treasuries every month and $40 billion worth of mortgage-backed securities every month, $120 billion a month. Wildly too loose of financial conditions. Fed governors were coming out saying, hey, I know you're starting to see the inflation peaking up, but it's transitory. It's just because of some supply chain issues that the COVID broke. Everything's going to be okay. They were singing that tune up until March, and really the inflation rocketed shortly after that. And they realized they had gone too far as liquidity, so to speak. And now they're drastically whipping back the other way, tightening the short-term rates are up over 4%, probably going higher next month. And they quit buying the bonds, the 120 billion of bonds in the open market. So completely flip things around and change the game. So now, of course, the $1 million question is, well, are they going to go too far? Are they going to tighten too much? You look back historically, and the Federal Reserve tightening every 100 basis points that they tighten, it tends to take about 1% off the GDP. Well, some of the things that some of the indicators that people are watching. Sorry, I backed up a little too far there. Some of the indicators that people are watching look pretty recessionary. I mean, they just do. This is the purchasing managers index, and then the service managers, the service index. That has all the economists are watching these numbers, and when you look at the history, going back to 2010, obviously shortly after the 2008 meltdown, a composite of those two indexes, has been running pretty consistent, for more than a decade. Obviously, the COVID, we had a huge recession in a very short period of time, and whipsawed back the other way as things improved. So now we're starting to roll back the other direction, and you have to wonder if the Federal Reserve is going too far. The gray areas, that's showing the gross domestic product, the GDP. So when you see 2 consecutive quarters of negative GDP growth, that by definition is a recession. So those are some of the concerning things out there. And when there are lots of financial pundits they're baking a recession in. They're saying it's absolutely coming. It's, if not already here, and it is absolutely unavoidable. Some of the economic numbers that have come out just recently are wildly bearish. The Baltic Dry Index, a shipping index over in Europe, this is the biggest. They had the biggest pullback last week in the price, the cost to ship goods, biggest pullback they've had since 1984. I mean, absolute, like, these are single data points, but some of them look very, very bad. You take a look at housing. But, some of the housing numbers are off. December to December, the number of existing home sales is down over 30%. Well, that's a huge pullback. But when you rewind to the December 2021, the residential real estate market wasn't red hot. It was white hot. So pullbacks on that can be understood. Magnitude's starting to get there, and if it continues, then of course we're gonna start to get even more nervous. But some of these things, just take a look at the drawdown in some of these index numbers and the GDP, attributable to COVID, and then the snapback. So some of these things are kind of whipping around that are understandable. You look at car sales. That's another example. With car sales down something like 10 months in a row, down 8% year over year. But again, the car market was maybe only red hot the car market a year ago. So a pullback in there is to be expected. And another thing, and we've mentioned this several times in our market updates weekly, when you have financial pundits baking so much negativity into the markets, and I hear from clients, from analysts, how bad things are, and yet these markets are holding together pretty well. So that's something to consider, without a doubt. The 2008s, right in front of 2008, weren't a lot of people as nervous as they are now. Big 2008 meltdowns don't tend to happen when people are already nervous, already sitting on big piles of cash. We'll see what happens coming up with the Federal Reserve. If they continue to raise interest rates, it looks like they're going to. You see the bounce in the stock market, the bond market in the last couple of days, and you tend to think that that's going to give the Federal Reserve confidence to keep raising interest rates. And then, of course, like I already mentioned, on the other side, you start to worry that maybe they're going to go too far. One thing that a lot of financial pundits have been talking about is, if you rewind all the way to the early 80s in the Volcker years, Paul Volcker, and he even mentioned it later in his tenure, regretted thinking that initial raising of interest rates was gonna stamp out inflation, because it didn't back then, and the Federal Reserve kind of eased off the raising of interest rates, and then the wild inflation hit. So there are a lot of people thinking that the Fed is gonna, if they're going to make a mistake, it's going to be overly tight, because they don't want to go back to a situation where they declare inflation has been stamped out, and then it rears its ugly head, in short order, within a quarter or something like that. So guesses are still out there that the Fed is going to raise rates again. Some of these economic numbers are wildly bad. Some of them are just kind of, like we're looking at right here, just kind of sort of bad. So time will tell if you feel like you've got too much risk in your portfolio. Great bounce in the market over the last couple of days, to let some of the risk in your portfolio go. I mean, again, you can go out there and get some guaranteed interest rates that are higher than we've had in more than a decade. So not an absolute train wreck out there, but some of these economic numbers really do have us concerned, especially if the Federal Reserve continues to raise rates. Because, and I mentioned this in previous posts, but I haven't so far today, most economists generally think that interest rate rises take 9 to 12 months to really filter through the economy. So if that's true, most of the work that the Fed has done really hasn't shown itself slowing the economy down. Well, if that's true, we could have some tough times ahead. So not super bearish, not super doomsdayish, but we are still worried. And if you feel like you've got too much risk on the table, now is a good time to take it off. I hope you like our weekly updates. We are here. If you need some help, feel free to reach out to us for a no obligation consultation. Please hit like on the YouTube channel there. Feel free to subscribe, and we hope we'll see you again next week. Thanks for your time.